A very warm welcome from ZoomStocks to everyone. To our viewers in India, good evening, and to Aswath and all our viewers joining in from United States, a very good morning to you all. ZoomStocks itself, it's a very simple, empowering social hub where people can explore Indian markets and practice virtual investing without iota of risk and try to gauge their view competitively and get rewarded for that. And if you like, we are on Twitter where we are following, multiple global markets in terms of economic stats and daily market moves, including India. So you can follow us on Twitter on that note. Now, what a better way we could ever imagine to celebrate our third anniversary, and we have none other than, the one and only, the guru of valuation, and I call him the oracle of valuation, Aswath Damodaran with us. Aswath, how are you doing today? A very good morning to you.
Good morning to you. I'm glad to be here. I'm doing well.
Yeah, great, great, great. Wonderful. Wonderful to have you here with Aswath. And just for the benefit of our viewers, Aswath is a professor of finance in New York University Stern School of Business. And he has, done some remarkable research work in the field of finance, corporate finance, and valuations, and is considered the highest authority in this field globally. Literally gospel truth. That's my honest take for that. And he's a very rooted, humble human being and dedicated his life to education. And yesterday was Teachers' Day. So, Aswath, on behalf of everyone who looks up to you and you have aspired them to, excel in their careers, professional and, research work or the learnings that they are doing and make a living out of it. So, on behalf of everyone, I wish you a very happy Teachers' Day and hold you in highest regards. It's a sheer pleasure to have you and highest honor.
Thank you. A couple of things. One is I am a teacher. That's
Yeah.
how I describe
Yes.
myself. And
Yes.
there are two words you use there that I want to correct you on. One is the word research. I am a dabbler. I don't do research in the traditional sense. I don't have the stamina to do it. And I don't have the attention span. I just move
Of
from
course.
topic to topic. And if you've read my blog, I move all over the place. I'm an expert on nothing, but that doesn't stop me from having an opinion on everything. And you also describe me as a guru or an oracle. That tells you a little bit about how shallow the investing and valuation space is, that you can become a guru or authority with almost nothing to bring to the table. I mean, nothing I say is original or different. It's just
Yeah.
reframing of issues. But I'm glad to be here. I mean, one of the things I've lost is the capacity to censor myself. So if you ask me a question, I'm going to tell you exactly what's on my mind, for better
Yeah.
or worse. And you're going to hear,
Absolutely.
you might not like what I say, but I have no agenda.
Yeah. And that's what we really, really revere, Aswath. I mean, unadulterated views, just as it is. I think that no one can do any better than that. And we're just lucky to have, that sort of an acumen and approach. So, Aswath, shall we get started on a few
Sure,
questions that we can get?
absolutely.
Okay. So, Aswath, the need for valuation is inherent, right? And we have had all these, abundant models are already there. Like what I'm trying to say, when we are trying to launch a rocket in space, every anomaly, every variable has to be factored in the best manner for a good success. So what I'm trying to say is that, like, DCF, simulations, multiples, regressions, all these statistical tools and approaches already exist. And like, what's your take? Like, in your view, like the lines are firmly drawn in school of thoughts and the methods and principles that we are following, or is there some more new work, exciting work, or new, uh, more scope that you see in this realm of valuation?
First, I think we've known what drives the value of a company for centuries. I mean, this isn't new.
Yeah.
It's cash flows, growth, and risk. It's as old as time. I tell
Right.
people, look, that Venetian glassmaker in the 1400s or 1500s was trying to sell his business. The value of his business was based on cash flows, growth, and risk.
Yeah.
There were a couple of things, though, that you mixed together in a group, or I want to separate. I mean, you said
Right.
valuation is inherent. Most people in the market don't know how to value things and they don't care. It doesn't matter to them.
True.
Why? Because
True.
they trade. Trading is a much simpler process. You can actually argue it's a more honest process because it's but buying at a low price and selling at a higher price. You talked about
Correct.
multiples. You use PE ratios or EV to EBITDA multiples or price to book ratios. You're
Yes.
basically pricing things. I'll give you the core
Sure.
difference between valuation and pricing. In valuation, the value of a business is driven by understanding the business, its cash flows, growth, and risk. And you might use an intrinsic valuation model, a discounted cash flow model to estimate it. In
Sure.
pricing, you try to estimate how much to pay for something based on what other people are paying for similar things. Let me repeat that again.
Sure.
You're not
Okay.
interested in fundamentals, you're looking at what other people pay. The old
Right.
Keynesian description of the stock market is a beauty contest where your job is not assessing who the best looking person on the stage is, but assessing who
Sure.
the other judges think the best looking person on the stage is applies to
True.
pricing. Okay?
Makes
And
sense. Got it.
much of what happens in the market is pricing. So, first, I want to dispense with the notion that valuation is somehow central to what happens in
Mm.
markets. Markets
Right.
are pricing machines, they're driven by
Sure.
demand and supply, mood and momentum, behavioral forces. So, if you're interested in valuation, you got to be interested for the right reasons, which is you want to invest. Investing
Right.
requires you to understand the value of what you're buying. You can't just
Right.
base it on what other people are paying. So that to me is the core difference. And understanding that difference makes the investing
Yeah.
process healthier.
Got it. Got it. Got it. All right. So, Aswath, I mean, you talk about what you say, contingent option model of valuation, right? So, would something like SpaceX could be a good candidate for applying that model?
I'll give an even better candidate. Right? If
Okay.
you take any platform company. I mean, let's
Yeah.
face it. The last decade has been the decade of platforms, right? People build
Sure.
platforms of users. So why would
Sure.
I pay for the Twitter platform or the Facebook platform, or even a
True.
smaller platform like the Snapchat platform? You're getting a
Sure.
platform of people who are on that platform 10, 15,
Right.
20 minutes a day. I think the Facebook, accounts for what 65 minutes of every day spent in the Facebook ecosystem. Then
Sure.
you think about what else could I do with these people while on their platform. It could be the
Right.
metaverse, it could be advertising, it could be games. There's an optionality when you buy a platform. Why? Because there are other things you could conceivably do with the people on your platform that you haven't thought about today but could add
Okay.
value. That's the options argument. The options argument says, look, I can value Facebook as an online advertising machine, which it is.
Right.
But when I buy Facebook, I get that advertising revenues, but I also get the potential that I could do other stuff with the 2 billion plus people who are on the Facebook platforms, the WhatsApp,
Okay.
Instagram, Facebook platforms. That's the
Got
options
it.
argument.
Okay. All right. Great. Well, I was hoping Elon Musk was listening to this and maybe a
I mean,
shareholder of yours.
bringing it closer to
Yeah.
Indian stocks, the Geo
Yeah.
platform is not a money making platform, but it's a valuable platform. You're buying
True.
optionality, which is as long as the Ambanis figure out a way to take that Geo platform and do other things with the hundreds of millions of people on that platform, they have a goal. This could be a gold rush, and that's what you're paying for with optionality.
Got it. Got it. Okay. So now, Aswath, importance of accounting for risk can't be stressed more, right? In your view, does the bottom-up beta versus the historical beta method, and like in a research paper I just read, there's a three-pronged beta model they propose, short, mid, and long term. Like which of these methods would we say better accounts for, or better attribution of risk and valuations?
I'm going to say something which is going to surprise you.
Okay.
If your discussion
Okay.
in valuation becomes a question of which beta should I use, you've already lost the script. No.
Okay. Okay.
Discount rates are not where valuations are made up. We kind of know roughly how much your
Sure.
required return should be for investing in stocks. How do we know? By looking at what's priced into the market. I think
True.
betas at the most finesse your value. They don't change your value. I mean, if you're going to screw up a valuation, which is not the end game, but if you do, it's not because you
Sure.
got the discount rate wrong or because you used the wrong beta. It's because you got the revenue growth wrong and the margins wrong. So I
True.
think that the less time we spend on discount rates and betas and risk-free rates and risk premiums, and the more time we think about business models and
Got it.
revenue
Got it.
growth and
Got it.
margins, the healthier the
Wonderful.
discussion becomes. I will say
Wonderful.
something about betas, and it's going to apply to only a small subset of the listeners here because most people don't
Yeah.
care about betas and they should not. Yeah.
Okay.
For that subset that has to estimate betas, the
Yeah.
reason I think I mean, with the bottom up beta, the average beta is the law of large numbers. One regression beta, which is the way you're taught to estimate betas in a classroom, is asking for trouble. It's one slice of history in one company. God only knows what number you get. So use the law of large numbers wherever you can in valuation to kind of allow for the fact that when you look at one point in time with one company, you might be getting a statistic that's not sustainable over time.
Got it. And I thank you so much for putting sharing that insight over there. Like, how do you think like the market should focus more on the healthier side of things, the cash flows, the free cash, and like the business model. So, and that drives me to the next question perhaps. So, like Aswath, we have a DCF and then we have the reverse DCF. Now, say if an analyst, so like this is T0, we have a stock price and a FCF that's available today, right? And then in the river, and then an analyst projects 1 year out, right? And then what should be the right way to find the growth rate? Should we just take a ratio what the analyst is forecasting as the T0 cash flow in year one, or should we discount that cash flow by our discount rate, bring it back, and take it forward and find what's the new growth rate, and then try to evaluate?
I'm confused. What analyst projects cash flow?
So
Analysts
yeah,
project earnings. They project price earnings ratios. They're pricers. I've never
correct.
seen an equity research analyst actually compute free cash flows and actually mean what they say. So I'm not sure what you mean by analysts projecting cash flows. Analysts project earnings and they project multiples and they apply a pricing, which is what their job is. I mean, equity research analysts are not hired to value companies, they're hired to price companies. The structure of the process itself gives it away. The way sell-side equity research works is you're hired as a sell-side equity research analyst. You're given a sector to follow. Let's say it's entertainment. You're given 20 companies, and here's your mission. Tell me which of these companies is most underpriced relative to the other companies in your group, and which ones are most overpriced. Their job is a pricing job. So nothing that equity research analysts do relates easily into discounted cash flow valuations or free cash flow of the firm. So if you're valuing a company, the last thing you should be looking at is what analysts are projecting, because they're playing a different game. It's got nothing to do with the game you're trying to play.
Got it. Okay. So now, as you say, people should spend more time on the quality of the business and that part of the equation. So like robustness of business model is a big valuation point, right? So in words of, like how would common investors, or put it in words of like Nassim Nicholas Tayeb, like how would they evaluate the anti-fragility of a business model, like from a common investor's point of view?
I think just understand what makes business work. Sit in on India is full of small cash retail stores. Sit in in a store and think about what that business person has to go through every day. I mean, a lot of people who value companies seem to have forgotten the basics of business, which is, to grow your revenues, you either have to cut prices if it's a competitive business, or or so that you can sell more, or you go for a premium niche product. Business models basically require a combination of common sense and understanding of what makes a business tick, which is, and so that often requires that you think about what it is that a business person has to do on a day-to-day basis. Less about free cash flow to the firm and growth rates and things at the generic level. Understand what makes a business work. And that gives you a foundation from which you can ask, how do I value a company? In fact, I teach two different classes. My first class is a corporate finance class. That's a class most MBAs take first before they come into my valuation class. And the second class is the valuation class. And they ask me what the difference is. They say, look, it's the same class. I just give it different names. But in truth, the corporate finance class, you think about value from the inside out. As a business person, you say, what drives my value? What can I do to change value? Which makes you think about the link between the inventory you have in your storeroom and value. What happens when you cut or raise prices and your value? Things which are healthy discussions about value, rather than change the growth rate in an Excel spreadsheet and say, I got a higher value for the company.
Sure. Yeah, I got your point there. Yeah. All right. Great. So, Ashwath, first of all, do you believe in the efficient markets narrative? And like, is is the capital structure model more relevant in efficient markets, or the markets are more operating on a random walk theory, right? So like the debt-laid companies were shunned recently, in last year around, when there was a very negative narrative about them in the market, right? So like the valuation have now recovered in some notable counters. Recently, they have recovered from where they were, the nadir they found, right? Now, does it leads the market to discount incorrectly or like too steeply at the word go, and they are just like a rational investor, maybe a little learned at applying some principles models, and not balancing the future growth rates or aspects properly. So like is the what I'm trying to say is an alpha being carved and netted out because of this bias in behavioral investing in the market. And like and if the company has been hitting the right numbers with maybe a debt laden model, debt heavy model, and hitting their numbers and the top lines well, so why does this situation arises in the first place?
The two separate issues. Let's set aside the debt issue or debt laden or whatever the issues are. Let's go to this
Yeah.
efficient market narrative. Efficient market is not a narrative. I mean,
Okay.
let me turn the question back on you. What did you say your
Okay.
platform was? What are you going to do? You're going to take people's estimates for companies and you're going to provide a crowd judgment,
A
right?
crystallized
I mean, let's face it,
crowd.
this is 15
Yeah.
years in the making, right? Think of how we pick
Sure.
restaurants to eat at. We no longer look at restaurant reviews, we go to Yelp. We look at, hey, what do other people like? When you want to see a movie, what do you check? You don't check reviews of movies, you check Rotten Tomatoes. No,
Yeah. Sure.
so in a
True. I do
sense,
that.
markets are just the oldest crowd wisdom around. A market price is the crowd judgment on what that
Hmm.
company is worth today. Could it be wrong? Of course. Can crowds be wrong? That's a generic question, right? Have you ever
True.
gone to a movie where the Rotten Tomatoes says this is an amazing movie and walked out and said, that was an awful movie? Yeah, absolutely. It happens, right?
Happens. Yeah.
Crowds are
True.
not
Yeah.
magical. They make mistakes. Markets
Yeah.
make mistakes too. That's irrelevant, right? Do markets make
Okay.
mistakes? Of course they do. Everybody, even the firmest believers in efficient
Yeah.
markets, accept that. The question is, can you find and profit from those mistakes? So the question we should really be asking is not do
Got it.
markets make mistakes, but are those market mistakes findable? And can you make
True. Yeah.
profits from them?
That's
And that's
true.
at
True.
the
Yeah.
core of active investing. Collectively, you know what the evidence tells us? Active investing
No.
doesn't work. Why doesn't it work? Because collectively, active mutual funds underperform the index in every single part of the world across every single style class. That's actually a pretty
Okay.
depressing starting point for somebody who wants to be
Yeah.
an active investor. You're climbing a mountain. Do I
Sure.
have faith that a few can make it to the top of the mountain? You have to as an active investor. But what I want people to recognize is winning at this game is incredibly difficult. Anybody who claims that active investing is easy, that you can beat the market easily, is either lying or it's at the core of a fraud. Markets are difficult to beat. Start with that proposition. So
Yeah.
if markets make mistakes, finding those mistakes is difficult. And the question you always have to ask yourself is, what am I bringing to the table that makes me a little better at finding these market mistakes than the random investor? Maybe you have a longer time horizon. Maybe you're just a more patient person. Maybe
True.
you're a sociopath. And I know that sounds weird, but let's face it, a lot of mistakes in markets come from emotionally reacting. And if you're a sociopath,
Absolutely.
you lack emotions, you might have an advantage over everybody
Hmm.
else. Now, keep that to
Hmm.
yourself. If that is the reason you're succeeding, you don't want to tell your clients, I'm a sociopath, that's why I'm a great investor. But you need to bring
Sure.
something
Yeah.
to the table to be able to take something away. And that's
True.
something that I keep repeating. So when you see you often see hedge fund managers claiming, I'm an amazing investor, look what I did over the last 5 years. I frankly
Right.
don't care what you did over the last 5 years because I can't separate luck from skill. But I'm going to ask you, what do you do that makes you special, that makes you different? And if you don't have a good
Yeah.
answer to that, then I'm afraid no matter how good your track record is, I'm not buying it.
Got it. Got it. And that makes sense. I mean, whether it's as you said, it's a skill to pick when the market is making a mistake. It's in a state of flaw. or is there an alpha being netted out or being carved out by biased investing behavior, as you were just discussing, like shun the debt narrative going through the market. So yeah, I got your point over there, Aswath, right? So and the next point that I would like to discuss with you, like intangible assets are a big draw for valuation, when it comes to especially tech companies, or like biotechs and or some other firms. Now it is being quite frequently seen that even well-established companies are trying to are incorporating intangible assets in a big manner. So what should be the approach to build this into valuation metrics?
You know how much time I've spent thinking about intangibles in the last 40 years? Almost none. You know who
Yeah,
really is obsessed with
yeah,
intangible assets? Accountants. And the reason is simple. Accounting balance sheets are historically have been built around tangible and physical assets. You have a balance sheet problem. And accountants have had struggled with that for the last 30 years. How do we bring things like brand name and great technologies onto the balance sheet? The reason I don't care is if the value of a company comes from its expected cash flows. Who cares whether those expected cash flows come from things you can see or things you cannot see? I'll give you a very simple example. Now, if I have
right,
to value a patent, which you can license out, I'm going to get the licensing cash flows, I'm going to discount them back, come up with the value of the patent. The fact that the patent is intangible is irrelevant. If I have to value a factory, I'm going to project the cash flows out. In discounted cash flow valuation, whether an asset is tangible or intangible has always been irrelevant. Accountants are fixated with this, and maybe they need to be because balance sheets matter to them. I have never ever had to look at a balance sheet to do a discounted cash flow valuation except in passing. I don't value companies based on balance sheets. I value companies based on expected cash flows. If you're basing it on expected cash flows, it really doesn't matter. You value Coca Cola and you've done it for 50 years. For 50 years, the bulk of your value has come from its brand name. The fact that you want to separate it now is an accounting
yeah,
problem, not a valuation problem.
got it, got it. Got your viewpoint over there as well. Now, talking of startups again. So, like in today's age, what is your view of valuation of startups in today's digital age? The cash burn cycle that happens, I mean, and then there's an inescapable cliff of either reaching the break even or even turning to good profit at some point in time. Yet the unicorns were getting coined quite recently with escape velocity. And would you like like the top VCs of the world booking losses in billions of dollars? So like is it like more of the availability, like cheap cost of funds and a mandate to rampant, mandate to deploy as much as possible to net that some super alpha that exists brought us to this corner. And and now we've been seeing since like last year a round of down valuations being happening across the startups in private space, private equity VC space, and then it does has a real impact, right? Your customers and your employees and your vendors. There is what is the impact on them and the business associates, and like how do you understand this whole scenario in terms of the economic impact? And the VCs, in some sense, are acting as a shock absorber to the economy, because was it the banking system more involved with their own funds into it, it would be more contagion. What we saw like run on the bank on SIVB recently. So and then some point in time, later point in time, we'll say the valuations have stabilized a little bit now, they are better. And then let's say the marquee investors in that asset now decide to exit by an IPO, right? So what does this means for an average investor, for a common investor, when they are going for that IPO, and even for the analysts? Like how do they grab around this whole loop, like what has just happened, but they are just going to get that exit piece with this whole story behind that.
First rule in valuation is don't get distracted, right? I mean,
Okay.
so much of your question went around distractions, the social impact, the economic impact, the disruptive effects. I mean, you
Okay.
can control only what you can control. So if you have to value a startup, that's going public. I mean, obviously, if it's going public, it's well past the startup age. First,
Sure.
recognize that VCs, I mean, this is going to sound like a broken record. VCs don't value companies, they price them. Think of how you make money as a VC. You enter at the right time, you exit at the right time. I've never known a VC who can value a business. I'll be quite honest. And this sounds like I mean, VCs are good at pricing. They price you based
Yep.
on number of users, number of downloads, the size of your platform. So
True.
VCs will encourage startups to scale up because that's how you get a higher price. They often will
Hmm.
discourage you from spending time on business models because you
Yeah.
don't get paid as much for building a business model. The time of going public, of course, you as an investor have a chance, an opportunity, but not an obligation to invest in an IPO. IPOs tend to be pricing games, which means if you're an investor, you're often better off sitting that game out. If you want to trade IPOs, by all means do so. If you bought Zomato at
Right.
72 and sold it at 150, you doubled your money. But IPOs
Absolutely.
will tend to be driven primarily by pricing considerations, not value issues. And that's something you
Okay.
need to keep in mind if you're an investor interested in investing in these IPOs. Can you value a startup? Yes, but it
Right.
does require
Right.
that you live with uncertainty because you're trying to build what a business model will look like for a company that might not have one yet. But it can be done
Got it.
as long as you accept the
Sure.
fact that you'll be wrong 100% of the time.
Got it. Got it. Got it. Very valuable, crisp, clear insights from you, Ashwath, on that count. Putting just matter to, I mean, putting the subject right to its matter. I mean, uh,
I
very
mean, we
clear
can
cut.
talk about the
Yeah.
social and economic
Yeah.
impact
Yeah.
of
Right.
having
Yeah.
the risk capital, explosion we had over the last decade, where too much capital flowed into
Sure.
young money-losing companies with no business models. We
Yeah.
encouraged too much disruption. What I mean by that is we gave, tens of billions of dollars to
Right.
disruptors of existing businesses, but those disruptors didn't have
Sure.
business models. So what we ended up with was we destroyed the status quo in these industries with the disruptors, but the
Yes.
disruptors themselves cannot survive because they don't have business models. Ride sharing, to me, is a
Right.
classic exercise in building up a disruptive model, whether it's Ola,
Yeah.
whether it's Uber. None of these
Yeah.
companies, or Didi,
Right.
makes money. But they've managed to destroy the status quo, at least in the US. Traditional taxi cab businesses have been devastated. But Uber
Right.
doesn't make money either. So, what do you gain as a society if you replace existing ways of doing business with new ones, if the new ones
Right.
are not sustainable businesses? I think
Got it.
we made disruption into a noble word in the last decade, and I was puzzled
Right.
when that happened because I remember being in middle school or lower school, and I know what happened to the disruptive kids. They sat in the corner or were sent home. When did disruption by itself become a noble endeavor? So, if you're going to
Yeah.
disrupt, I think that it makes sense if disruption comes from a new business model that makes more sense. But
Got it.
disruption for the sake of disruption, which is what we did in a lot of sectors, I
Yeah.
think it was extraordinarily destructive for society and
Right.
the economy.
Absolutely, absolutely, and I, thank you so much for hitting those notes. I mean, that was the sort of view and the insight I wanted to hear from you, and thank you so much for sharing that. Now, on a similar note, now we are starting to talk about startups. So, like, in their initial cash burn phase, when they are, building the huge ecosystems and say like competitive and tech advantages. So is DCF still, just a quick question, is DCF still the most valid way to value
DCF
them,
is,
or one should look at
DCF,
unit
let's
economics?
take DCF out
Unit
of the
economics.
conversation. Intrinsic valuation is
Yeah,
about business models and valuing businesses. So whenever you feel
correct.
the urge of asking, does DCF matter? Replace
Okay,
that with, does building business models matter? It kind of
got
takes
it.
the conversation to a different place. Does building business
Absolutely.
models matter? Of course it does at every stage in the life cycle.
Sure.
DCF is just a framework for taking that business model and putting it into cash flows, growth, and risk. In fact, anybody
Right.
who claims that DCF doesn't matter is basically saying it doesn't matter whether you build a business model. That strikes
Yeah.
me as absurd.
Hmm. Interesting. And the last part was it like, would unit economics be more well placed to get a sense of where these companies are headed in terms of valuation and
Is
future
what I'm
prospects?
sorry, what is I missed.
Unit economics.
Unit economics are a big part of a business model, right? I mean, that's why I think
Sure.
when you sit behind that retailer in a cat in one of those little stores on the stores, you know what he wants to
Yeah.
sell, right? He wants to sell the products where he gets the biggest margin. So you
Right.
walk into that store and say, "What should I buy?" He's going to lead you to the item on which he makes an 80% growth. That's unit economics at work. That's business
Yeah.
models. So when you think
Got it.
about business models, unit economics matter, economies of scale matter. All the things we put buzzwords on are really at the
Sure.
core of building a business model. Because if you have bad unit economics,
Yeah.
effectively it means that in the extra unit you sell, you get to keep very little. No
Hmm.
great business can be built of that unless you have huge volume. Discount
Right.
retailers have bad unit economics, but they can get away with it because they sell hundreds of billions of dollars. So unless you can show me you
Correct.
can scale up your business to immense
Hmm.
dollar values, bad unit economics will work against you.
Got it. Got it. All right. Okay. Now, a question on a different aspect, like what is your approach to revaluation or revaluation of assets and liabilities of different companies in different sectors? Given other than their book value, like when the analysts are making these investments adjustments, investments, putting them back to the FMV. So, is there a bias that can set in at that
It's a
period of
balance
time?
sheet.
And
As I told you, I never use balance sheets. I have
okay,
never
got it.
valued a company based on its balance sheet. Because the
Right.
minute you say assets and liabilities and fair market value, you're basically talking about a balance sheet approach to coming
Yes.
up with value. That's not intrinsic
Right.
valuation. That's not discounted cash flow valuation. It could be liquidation valuation if you're trying to sell a business based on its assets. But if you're
Right.
doing an intrinsic valuation, who really cares what's on your balance sheet? Other than your cash, everything else is a made up accounting number. Most of the time,
Okay.
it means close to nothing to me. So I'm not sure that looking at assets and liabilities and coming up with the difference is giving you a leg up in doing intrinsic
Yeah.
valuation. It might be a pricing basis, but it's not going to give you a valuation base.
Got it. Got it. All right. Another question, a little broad-ranging question. Like in the context of global equity markets, how do you think like the cultural, regulatory, political factors affect valuation and investment strategies? What role does behavioral finance plays in equity valuation? And how do cognitive biases affect investment decisions?
Let's take the second half. Cognitive biases,
Okay.
behavioral factors have zero effect on value. You know what they affect? They affect the price. That's
Right.
the healthy part about separating value versus price. All of
Right.
behavioral economics, you can argue, is designed to explain why price can be different from value and stay different. Remember, the core faith when you invest is if the price is different from value, there's going to be a correction. But behavioral finance says there might not be a correction if there's a strong behavioral force at work, at least in your lifetime. So when you hear about
Hmm.
behavioral forces and momentum and mood, you're talking about a pricing issue. Okay? So I
Right.
think that keeping the discussion about are we talking about value, are we talking about price, kind of brings the discussion back to a healthier place than mixing the two up and saying, why, if the market's in a good mood, how will it affect
Yeah.
value? It doesn't. It affects price. And of course,
Right.
price is a big factor because that's the only tangible number on the ground. So it does explain
Right.
though why price is more volatile than value will ever be.
Hmm. That makes sense. All right. Got your views over there, Ashwath. Another question, quite straightforward, or maybe a little bit differently spun. So, like corporations have a what you say, like a plethora of choices to make. They can either target to enrich their shareholders by cash flow, which is your dividends, or they can reinvest that profit into some more future-looking, forward-looking projects, or in the research, or some other aspects, right? So let's say a corporation is able to hit both the targets A and B, say within the same time period or like across different time periods, right? What I want to know, like, is the market going to react differently in terms of price, as you have been speaking? Like, like which aspect of hitting the target is going to give a more surge to the price, or I mean, of course, the valuation could be low or high, but which one is market going to have appreciate more?
I'm not sure. I mean, the question. I first you said corporations can enrich your objective as a corporation is always to enrich your shareholders. The only difference is
Sure.
whether you enrich them with cash flows today or with price
Yeah.
appreciation, right? That's basically
Yeah.
it. If you're
Yeah.
asking me which one's better, it depends on the company. If you're a mature company, then the bulk of your returns are going to be in the cash flows. They're not going to be in price appreciation, not because you don't like price appreciation. It's because you're
Right.
mature. If you're a growth company and I'm buying you as a growth company, if I'm buying NVIDIA, I expect most
Right.
of my returns to be in the form of price appreciation. You
Right.
let's say you make $1 million in price appreciation or $1 million in cash flows, it's still $1 million. Either way, I'm happy
True.
as long as you enrich me. The common theme is you want
Okay.
to enrich your shareholders. It's not whether you enrich them in cash flows or whether you enrich them in price appreciation that matters. It's really
Okay.
whether you enrich your shareholders. And the core principle that drives whether you should pay out dividends or whether you should reinvest is, do you have projects that make more than your cost of capital? Can you actually deliver value? If you cannot,
Right.
the simple answer is give the cash back. If you can, then
Sure.
reinvest the
Sure.
money, go for growth, and give me price appreciation. Either way, I'm okay.
All right. And now you touch base upon that, like, either go for a project which has, a higher NPV or not. Then I was, just came
No,
across a
go for a
research
project with
paper.
positive NPV. So
Sure, of
don't
course.
assume that there are a plethora of projects out there with the incredible NPVs that you get. Most
True.
companies are beggars, not choosers. Most of their
Okay.
projects don't make their cost of capital. We don't live in a world of plentiful, value adding projects. Value adding
Hmm.
projects are at a premium. Relatively few companies have access to those projects. So if you can find a positive net present value project, I'm okay with that. It doesn't even have to be a hugely positive. It just has to be
Right.
positive.
Right. And then there was a research paper I just came across some time back, and it was talking like how could a common shareholder, try to understand whether, with the same set of research and variables at hand, they're trying to pick a good company in terms of, generating the alpha, or like whether it's below the valuation. How can one look into the companies, like are they using the best principle of NPV to choose their projects? And also on another note, like when the interest rate regime has changed, or something else has changed to change your WACC. Uh,
Mhm.
so I mean, is how can a common investor understand, like, they are incorporating actually that?
This has nothing to do with common or uncommon. It's not like
Right. Yeah.
outside investors versus insiders. That's really the difference.
Sure.
Insiders in a
Okay.
company can see individual
Right.
project details. If you're
Yeah.
outside the company, you can look at what the company does across a portfolio of projects. So
Okay.
basically, all you can do is use approximations. One approximation that I kind of report on every year is you can look at the return that this company makes collectively on all of the
Okay.
capital it has invested across its projects. It's a
Right.
return on capital. You can go through the
Sure.
mechanics, but it's looking at collectively what does this company make and compare that return to the cost of capital for the company. About
Okay.
60% of companies globally last year earned returns on capital that were less than the cost of capital. That's why I said, don't look at a small net present value project and dismiss it, because you're already a winner if you can create a positive net present value project. So
Right.
most companies have difficulty making their cost of capital. If you have a company that delivers more than your cost of capital, you're already a winner.
Okay. All right.
I've got it.
I think.
I've got to tie up in a minute. So we're at
Okay.
that.
All
Yeah.
right. Just a quick question, Ashwath. Like, I mean, when the like right now you see in the U.S. markets, right? The yields are rising and the markets are at all-time high. I mean, one of them has to be always wrong, or like, I mean, some sign of a warning when both start running high. I mean, in terms of market valuations and the multiples that we are assigning to
The
investments,
yields are
or
rising means bond markets are going down, right?
yeah,
Rising yields lead to lower bond prices.
sure,
So if you look at
yeah.
last year and a half, stock prices are up, bond prices are down. So when you say both are going up, I'm not sure what you mean by both. I mean, the
I
yields
mean,
are going
just
up, but
the
bond
yeah,
prices are going down. Are you
true.
saying stocks are going down or up?
So I was just talking in terms of the yields moving higher at the same time. I think I just made a very fundamental mistake in asking that question, because it's just stretched across. So I apologize on that. That's a
Yeah, it's
very
okay.
fundamental error. So and just last question before you go. So like there has been a recent narrative, like your like Russell is like NASDAQ is very highly valued compared to Russell 2000.
Mhm.
So, I mean, what's your take on that? I mean, in terms of a very highly dispersed index, uh,
The
I mean,
NASDAQ is a tech index. It has a lot of growth companies. The Russell index is a
yes,
small cap index, which is
right,
nothing to do with growth, right? Small cap stocks are often low growth companies as well. So growth is
right,
growth is what's driving the Nasdaq up. We can debate whether it's been driven up a lot, but remember the Nasdaq is dominated by a few big tech names. You take the top 10 tech names out of the
right,
Nasdaq, much of the upswing in the Nasdaq leaves as well, right? You take Nvidia, you take Google, you take those stocks that are essentially dominating the Nasdaq out of the top 10.
right,
Much of the
right.
Nasdaq price appreciation goes away.
Okay. All right. So, Ashwath, I think you have enriched us a lot with your crisp, clear thoughts over there, and giving us a view, a step beyond. Like as you said, bare knuckles view when you went to the startups and the VCs, and you said the valuation part is actually not there. It's the pricing that they are more looking for. How can I make it to the next level? And then the startups not having the business model, but more on the disruption side. And that's what that you have
Thank you
shared.
for having
Yeah.
me. I was glad to be on. Take care.
Thank you. Thank you so much, Aswath, and
Bye
wish
bye.
you a brilliant day. Thank you so much. Thank you. Thank you for
Bye bye.
joining us. Thanks.